Hi, I'm Michael Glennon from Glennon Capital, and this is my colleague Alex Shevlev, who helps me manage our small companies portfolio. What we've just come through is the 2016 reporting season, which on aggregate was pretty good, but what we feel like we've entered into now is raising season, where a lot of small companies are hitting the market for additional capital for various different purposes. One of the reasons capital is being raised now is that we are in quite a low growth environment, so we're seeing companies raising capital because there's not a lot of organic growth in their business. So Alex, you've seen a few of these capital raisings recently. We've participated in a few. Do you want to give some of your thoughts on that?
Sure. So it seems that within a lot of companies, businesses at the moment, organic growth has slowed. And what companies have the option of doing now is to look at companies that are in similar segments to themselves, in similar businesses, in different geographic regions, for example. And we've seen a couple of those come through even in the last couple of weeks, even in the last couple of days. So we've seen, for example, Bapcor, the old Burson Auto Group, make an acquisition in New Zealand. Complementary businesses. We've seen Skydive the Beach, which is another of our portfolio companies, and they've acquired a similar business in Australia, but along different verticals. So all of this helps to grow the business inorganically, and the other thing it does is when you look at the multiples paid for companies that are either smaller public companies or private companies, often there's an arbitrage. A publicly listed company might be trading at a multiple of 10 times EBITDA, and they might be buying at lower and perhaps single-digit EBITDAs. And that helps because that provides accretion to the acquirer.
So while the capital raisings are good in terms of companies that are shoring up their balance sheets for future acquisitions, as well as buying earnings and getting that sort of private company to public arbitrage, we're actually quite cautious at the moment about the market, given the fact that there isn't a lot of growth. Companies are starting to look for acquisitions to really bolster their earnings, and a lot of them are under pressure to do it because they're trading at relatively high PEs, because we've seen a shift from traditional large cap fund managers who are looking at top 100 stocks where there's been benign growth, and they're moving down into the small cap companies that have got earnings momentum and some positive share price momentum, and those companies were historically cheap, post sort of the GFC and the demise of sort of the whole resource boom. So there are starting to get some pockets, some bubbles of expensive companies in small cap land, and we're seeing there is pressure on companies to achieve growth. So we think there will be more acquisitions. What that's meant is we've sold some of our larger positions in the portfolio, and we're actually looking further down the market cap spectrum into sort of more micro cap companies. And we think that the larger companies will keep fishing in that pond because they are still relatively cheap. A lot of them are still growing quite well, but we will see further capital raisings over the next 12 months as companies continue to make acquisitions to bolster growth in what is quite a benign economic environment. So that's our thoughts on the market and what we think's the outlook for the next 12 months. Thanks for watching, and if you want more updates on what we've been doing, you can follow our YouTube channel or look at our website and sign up for our newsletter. Thanks for watching.